We're talking the dollar, oil, and the U.S. midterm elections with Peter Hugg, who's back from Hong Kong and joins us this Tuesday morning. Peter, good to be with you.
Yeah, it's good to be back, Daniela.
Now, Peter, if we look at the recent headlines, they all seem to have a common denominator, which is the dollar. So last week, we saw quantitative easing stop in the U.S. And at the same time, almost it seemed perfectly timed, the Bank of Japan announced more quantitative easing, which lowered the yen, which in turn helped the dollar even more. And now this week, we have the ECB meeting on Thursday. And recent dour economic data coming out of the European Union, coupled with Japan's fresh monetary stimulus from last week, suggests the ECB will move to enact more monetary stimulus sooner rather than later. Peter, what are your thoughts here, and what impact could this all have on gold?
Well, when we spoke last week, what I was looking for specifically was any sort of change in Yellen's posture and language, towards future action. I fully expected her to end QE, which happened on Wednesday. But I was looking to see if she would tie any of her remarks as to what monetary policy would be in the United States relative to what was going on in the rest of the world. And she did not mention that. And gold took out $1,202 and didn't look back and washed through 1183, triple support fairly easily. So we find ourselves in a situation where, again, based on our comments going back at least, I think, 6 months, if not 9, that we believed that the U.S. recovery was ahead of the European recovery, and more than likely U.S. rates would stabilize and go higher as the EU would continue to be expansive in their monetary policy, and with Japan adding a sort of QE program in and of itself a couple of days ago, you're seeing basically a currency war. And the Europeans and the Japanese want their currency down. They want to try to export their way out of this slowdown in their countries. And the beneficiary of that is the U.S. dollar, which historically is a strong dollar is negative for the commodity complex.
Now, Peter, let's turn our attention to the news of the day, which is the U.S. midterm election. Do you think physical gold buyers are waiting to step in, waiting for the results of the election? Now, I know in your morning commentary you suggested that the election doesn't have a direct impact on the direction of the metals, but it could influence equities, and in turn could influence the U.S. dollar, and in turn can influence metals.
Well, we are starting to see some physical pickup in demand, especially from the Far East in gold, and to some extent in silver under the $16 handle. I think the elections, the Republicans may take the Senate, but, for the next 2 years, you're going to have a lame duck president. I don't think anything gets done in the U.S. for the next 2 years. Certainly not on fiscal policy, which I think is where the Congress and the president need to come together, because the Fed can't keep this boat floating forever. The metals aren't directly tied to the election. They're sort of collateral events that will occur that could create a move in the metals markets due to the election results that come out tonight.
All right, Peter, let's talk oil now, which hit a 4-year low after Saudi Arabia signaled it would lower prices in the U.S. Now, we know oil and gold tend to move in tandem. So does the bad news for oil spell out bad news for gold?
You can look at oil from two perspectives. One perspective is that the U.S. production of oil through fracking has created less demand from the United States, which is certainly true. And you add that lesser demand coming out of the U.S. with a serious slowdown in the European economies, and to some extent in the Chinese economy. And the demand for oil on a global basis has also dropped. So, this price drop in oil is certainly logical. But I would imagine oil getting down into the low 70, 72 range, that might provide a floor somewhere between 68 and 72. I would suspect the floor.
All right, Peter, before I let you go, let's just look at some gold levels here. And I know in your commentary this morning, you suggested that if we get over the 1172 level, we may see a short-term pop with 1165 then acting as a support.
Yeah, it's a couple of last days, it's bounced off the 1165 support line. I think if we lose that, we're in danger of seeing gold coming into the 1140s. But I think the market is aggressively short here. And so if we get, something over 1172, sort of 1175 range, it wouldn't surprise me to see a pop. Now, that doesn't change my technical posture, which is still bearish. But a pop back up into possibly a test of the 1183 resistance line, I think comes into play. The market is overly short here, so any surprise should be to the upside. The overall momentum, though, is still neutral to bearish from a technical posture on this market.
All right, Peter, thanks so much. We'll see you next week.
Okay, see you then.
And thanks for watching this edition of For Pete's Sake. We'll see you Wednesday.